Hello and welcome to the third module of this course, Blockchain for Finance Professionals. So let's get started with the third module, which will cover everything about cryptocurrencies. In this module, we will get an idea about Bitcoin, the first blockchain, why cryptocurrency is needed, evolution of cryptocurrencies after Bitcoin, the other altcoins, ICOs, etc. So let's start with the first blockchain with Bitcoin, and later we'll discuss the Bitcoin fundamentals. So we have covered almost module 1 and module 2. Module 3 and 4 will be covering more detail on cryptocurrencies and the blockchain frameworks that actually helps in the financial services. We'll be touching on the bit detail how Bitcoin has actually helped in this section. So first blockchain use case, as I said, is Bitcoin, right? So we go on a little bit of what is money. Money is like a physical or electronic tokens of commodities that have the following properties. That means it has a defined value, it has an acceptability, and it is non-perishable, right? So it be dollars, Indian rupee, or any of the tokens or anything that actually where you can exchange. So what is electronic money? Basically the exchange of tokens of money that gets transacted only electronically. For example, digital gold currency, Facebook Gold, and other electronic currencies. So the money from physical to a bit changed to electronic money, and it can include even the authorization of credit cards, value holding tokens, and other examples. And actually, the currency that has value is being widely used. So Bitcoin is a startup currency with a deflationary bootstrapping economy. So that's how Bitcoin started. It's a kind of electronic money. So we can see like how the early money came in, early tokens of exchange, commodities or objects of perceived worth, minted coins, say for example, standardized units of metal, trade bills. Similarly, typically goldsmith, they demand deposits and promissory notes. So these are some of the early money. So modern fiat money, you have World War I and end of gold standard. And basically, gold was pledged as a main fiat currency, and fiat money is like whatever we are using the country. Every country has a fiat currency, like India has Indian rupees and US has US dollars. And then it started with decree of government, where it's basically under public uncontrolled, so that its issuers, depending on the issuers, it was basically ability to pay debts. And then the entire thing changed to electronic money. We have private currency, we had community currency, we had world currency, we had hard currency and soft currency. So just these are some of the legacy stuff on the electronic money. Private currency, basically it is free banking. There is no central reserve bank. Free entry into banking industry. Some of the characteristics are free entry into banking industry. Freedom to issue notes, accept deposits and collect checks for payment. Freedom to borrow money on term deposit, and freedom to lend money and invest assets. So this is one of the private currency. Then we had community currency like Toronto dollar, Ithaca hours, and Berkshires. Then we had now we have world currency, basically gold, British pound, US dollar, euro, yen are all global trade references. And we also have a International Monetary Fund, which kind of monitors the funds which is required for the global level. So let's come to Bitcoin. Bitcoin is a simple way of sending and receiving numbers to and from address. So simple, it's as we understood, it's basically alphanumeric characters. It's based on encryption that goes between a buyer and a seller, or between one individual to another individual, in just having electronic addresses. So it's an open source peer-to-peer network. It uses digital signatures and encryption, and decentralization is the basis for Bitcoin security. So we already touched this. We had this public-private key information also, and we saw how digital certificates are enabling blockchain. It's an open source peer-to-peer network. It uses digital signatures and also encryption. So it started in 1999, and actually in 2009, this is actually found by a mysterious man called Satoshi Nakamoto, but in a document called Peer-to-Peer Electronic System. And in 2009, it started. The first transaction started verifying using blockchain. And even in 2018, it actually reached $20,000 per Bitcoin. I couldn't include in the 2017, it reached actually $10K per dollar per Bitcoin, and it actually went, the max it went was like $20,000. 2017. So there's a huge interaction between Bitcoin and cryptography. So Bitcoin is actually a collection of concepts and technologies based on the digital money ecosystem. So what are the characteristics? It's basically a decentralized peer-to-peer network. That means it is enabled by Bitcoin protocol. It's a peer decentralized because this was the first decentralized ledger technology use case. The second, it's a public transaction ledger. It works on the blockchain. Then it is having a mathematical and currency issuance mechanism. That's what we saw, distributed mining and the proof of work concept. So in early 2009, you can mine a Bitcoin using your laptop or a desktop, but now you need high compute powers and the algorithms have changed. And there is a decentralized transaction verification system. So it's like you need at least 51% approval for any transaction, and all the invalid blocks gets out of the ledger with proper verification. So why it is important? Because the Bitcoin system is based on the decentralized trust and it heavily relies on the cryptographic technology. So we did see the way hash functions SHA-256 and RIPE-160. So these are two hash functions that Bitcoin uses, and it's also based on elliptic curve digital signature algorithm. So very important algorithm. So if somebody asks what are the cryptographic function, it has SHA-256 and RIPE-160, and it's based on public key cryptography, which is the elliptic curve digital signature algorithm. So you can see this in a Bitcoin on the right hand side. You have a private key. He is sending this money and it goes through SHA-256 in the flowchart, and it uses RIPE-1, and then the other address receives this money. So in Bitcoin, a transaction is recorded, basically informing the network that there is a transfer from one owner to other owner. How ownership is attained? It is basically ownership of coins through digital keys and Bitcoin addresses and digital signatures. So the entire algorithm is based on elliptic curve digital signature algorithm. So that's what you see as the base 58, the kind of digital signature algorithm that helps. So the private key is initially generated at random and is kept secret all times. It is actually used by current owner to digitally sign a Bitcoin transaction. So when you authorize the transfer to the new owner, a digital signature confirms ownership and can be used to verify the transaction, whether the transaction is authentic or not. So a very simple two-step process. The private key is generated who is having the Bitcoin as a owner, and then he digitally signs the Bitcoin transaction as an authorization, and then the digital signature confirms the ownership and see whether the transaction is authentic. Then there is a public key which is generated from the private key, and it is used for a new owner to validate a transaction digital signature. See, one is private key, it gets converted later as a public key to just verify the transaction's digital signature. So when transactions are broadcast over the network, you see like it is using SHA-256 algorithm. So the reason why it is using this algorithm, because it needs to have data integrity. That is, the data was not corrupted or modified during transmission. So that is very, very important. And if you understand, all Bitcoins are stored in blocks. We did see how in earlier modules, how each block is modified and then edited, added, and gets mapped to the previous block. And the entire sequence is called blockchain. So what is actually a cryptographic hash functions? Why it is used? It's basically used to verify block integrity and establish the chronological order of the blockchain. And Bitcoin, that's why uses this cryptographic method, which is advanced, and there are more advanced technologies which is coming in the market now. Essentially, why we need SHA-256 is basically to protect the data integrity and also the block integrity with the chronological sequence of the blockchain. Furthermore, the hash functions used is basically used as a proof of work. That means you have seen, right? Everybody can join a miner club, right? So a prominent algorithm of Bitcoin mining, which is discussed a session, which we did touch upon this earlier, as a proof of work. That means who produces more and more. You cannot create new Bitcoins. The only thing, Bitcoin can be mined. And in that case also, we need to understand that the mining depends on the compute power and the algorithm that runs into it. So again, I'm just reiterating, in Bitcoin, all transaction information is publicly visible to everyone in the network, and transactions are not encrypted. However, Bitcoin heavily relies on the digital signatures, mainly the public key cryptography to verify transactions. There are two keys, kprov and kpub. The private key, which must always be kept by the secret owner, and kpub, the public key, which is visible by everyone. So you have one that is used for the sending the money and receiving the money by the owner, and the second one which is authenticating the transaction using public keys. So you have two components that's kind of used as a public key cryptography. So that's all about the session. In the next session, we'll know more about Bitcoin and its advanced concepts. Thank you. Welcome to this session, and in this session we'll deep dive into more on Bitcoin concept in advanced level. How Bitcoin works, we have seen but again we are reiterating. The blockchain is the fundamental data structure of Bitcoin protocol. It's a single data file participant which passes from one person to another. So it allows to understand who owns it. So we have seen blockchain is a protocol which runs for the Bitcoin. It's like a file participant pass from one data to another person, a kind of data structure. You can always see who owns that, and you can always check who is then going to change the money or anything else during the transactions. And others can actually verify using mathematically the transaction whether it is valid or not. So essentially, it's like a accounting ledger. So you can see like from one Sally, $15, how Sally to Jimmy, it went up to $2, and you can always check how much money does Sally have in her wallet now. She had 15, then she gave to $10 to Bob, then $4 to Barb, then was given $2 from Jimmy. So as of now, you will see $3 is what Sally has. So very simple example. So all that we deal is kind of dollars here. So it's accounting ledger. So let's understand the anatomy of transaction. Suppose you need to have 50 Bitcoins that you need to send. So first it verifies as the person who can receive the money or not. And then the second is like verifies the person can send the money. Then you can see like, there is a fee that is charged on a transaction. And similarly, you can see the other transaction as 100. And if there is any fraudulent transaction, it comes as a red. You can actually see in the thing. So what are the input that contains is? So input contains is a public key belong to the redeemer of the output transaction. So he is trying to redeem it. Then there is a ACDSA hash over a hash of the transaction. And then output contains like the actual amount being sent to the recipient. And there is any change that is get back to the original sender, the voluntary transaction fee attached to the output. So there's always a transaction fee that happens. And so it's very easy. One input that goes as a public key, and there's a ECDSA hash that runs on the transaction. And you can see whether the other amount being received by the recipient, if there is a change in the sender, and if any fraudulent transaction, you can deduct that. And fee is like voluntary. If you want to give as a voluntary, you get attached a fee. So basically what happens is the entire transaction is happening on the blockchain ledger. So the blockchain prevents the double spend. That means like it gives the nodes the power to verify that transaction inputs were already spent somewhere else. That means if you take 24, whether it has been already used by one receiver or a sender or a buyer or a seller. So blockchain actually gives you the verification to prevent the double spend, because that nodes in the chain actually has the power to transact mechanisms verification. So mining is actually, we did understand. So basically what happens? Miners collect the transaction on the network into large bundles called blocks. So it's like Alice pays Karim 10 Bitcoins and Liam pays Sophia 8.3 Bitcoins. So basically these blocks are strung together in a continuous authoritative record called blockchain. So we have seen this one block as a header, nonce, and a transaction. So basically why this blocks is continuous. And one more thing, we see the longest block and the faster it is. So basically a blockchain doesn't permit any conflicting transactions and lets you know for sure exactly which transaction counts and which can be trusted. That means like if there is any transaction happening on the same, this is already happened or not, or is it a valid transaction? That means like it shows the proof that double spending is not happening. So Bitcoin and blockchain, Bitcoin makes sure that there is only one blockchain by making blocks really hard to produce. So, and miners have to compute a cryptographic hash of the block that meets the certain criteria. So it is difficulty for the criteria for the hash is adjusted based on how frequently blocks are appearing. But important thing is it carefully validate all the transaction that goes into the block. And you understand that successful miners are always awarded some bitcoins according to a preset schedule. So I have shown you an example in the earlier module where you can see the transaction speed per second on various Bitcoin mining machines. So the first two thing learning is it makes sure that there is only one blockchain that is very really hard to produce. And second, it validates all the transaction that goes into the block. You can also see that users can trust the blockchain that was most difficult to produce. And I already told longest chain wins. So if there is a fake chain competing with the real ones, the fraudster has to do as much as work as the rest of the network to make the block as trustworthy, which is very tough. So it is intense work that goes into finding blocks through hash securing, and it is very difficult to produce a fake blockchain, to be very precise. So they are just going again for Bitcoin mining. It collects transactions from the network, it validates them and doesn't allow the conflicting ones. It puts them into large bundles called blocks. It computes cryptographic hashes over and over until it finds a good one to count, and then submits the block to the network, adding to the blockchain and earning a reward in return. So this is a process, and this is how Bitcoin mining is very successful. Bitcoin security, we have seen that Bitcoin is actually used on the race integrity primitive evaluation message digest, or what we call RIPE-MD, of SHA 256 of elliptic curve digital signature public key. So if there is any vulnerabilities in the algorithms, it actually creates a vulnerability in the Bitcoin itself. So any attacker with 50% can do double spend, reverse transactions, or prevent some of the transaction, prevent some of the other generators from. So it is little difficult, but then you need to have a greater than 50% hash power if there is a real attack, a cyber security attack. So Bitcoin concerns wallet vulnerable to theft because it's a public key. Tracing a coin's history is little difficult. Packet sniffing is always there. Sybil attacks, some kind of attacks has already happened, and no authentication for IP transfers because sometimes we don't even know from where they are accessing the networks. And this attack is downright because if you are using for Tor, and denial of service attack, so DOS is little there, and there is some illegal content which is has shown some extra already in the chain in earlier cases. There is a lot of energy consumption. So these are some of the concerns, but then people have overcome these concerns with the newer blockchains. So you can see some of the example of the transactions done per day. This is available in blockchain.info. So with that, we complete the Bitcoin and how it is the first use case of blockchain and how it can be used for as a sending and receiving money. I hope you got a good overview on Bitcoin after completing the session. Next, we will know more about the evolution of cryptocurrencies. Thank you. Hello, let's start the session with one of the most interesting topics, evolution of cryptocurrencies. So let's jump to the session. We are in the section where we will be discussing more on the cryptocurrencies, the evolution, and how altcoin has started growing. So basically, any coin apart from Bitcoin is actually called altcoins. So if you see, there are a lot of blockchain systems, and the other side, there is one way that Bitcoin is only one of the cryptocurrency, and it has a blockchain-based mechanism. There are a lot of new innovations that's happening in cryptocurrency and in blockchain. So you have new blockchain in systems, and we have decentralized apps. So there is a substantial innovation that's happening in the altcoins and the new blockchain systems. So because of the sorry about this slide actually, there are a lot of sectors where cryptocurrencies are used. There are exchanges that's coming in where you can do purchase, sale and trading of cryptocurrencies. There is wallets, like it's already there in Bitcoin, but there are many wallets now. There are payments. You can do payments using cryptocurrencies. Then you can do a mining, So basically it's just not about Bitcoin mining. You have other alt currencies that you can mine as well. So basically, what is a door opener is the cryptocurrency. So basically, it's a revolutionary technology possibilities You have smart contracts, you have smart properties, you have bonded identity services, you have notary services, whatnot. So these are some of the applications of cryptocurrencies or the blockchain-based cryptocurrencies. So what is cryptocurrency? It is a digital currency that uses cryptology for security. That is cryptocurrency. The important parameters are: it is decentralized, it's not issued by any central authority, it is trust-based on peer-to-peer consensus, it is anonymous, it is no more identified to your identity, or transaction not identified to your identity. And what is the first and most popular cryptocurrency? It's Bitcoin. So what is this cryptocurrency? It's a digital currency that uses cryptography for security. So why it is used? It has almost no transaction fees compared to credit cards, and it's built in customer base of customer cryptocurrency enthusiasts. So you can see, Shopify, which is one of the largest online platforms, is now offering Coinbase, which is a cryptocurrency platform. Then you see Rakuten, which is a retail giant, e-commerce giant from Japan. It started using cryptocurrencies. Why for users? Basically, it's a fun. You can mine using community. You can do trading. And you can probably get rich. And it's but it's not even managed by a central trust. So if you see the largest cryptocurrency, that's still Bitcoin, and the second biggest is Litecoin, but it is easier to mine. These are some of the examples, and there are other altcoins. So you can see some of the altcoins here. This is from one of the altcoin sites, just for information. So why you are looking at an alternative currency? Bitcoin is the first application of a technology that paves the way for a opportunity for innovation that didn't appear before, or that was not apparent before. Bitcoin is wholly open source, so it can be tweaked, modified, altered, or tested, just like evolution. Bitcoin's blockchain has almost grown large, almost like 120 GB, and will become larger and larger as more widespread use of it. And then it is argued by power of mining. That's it's now you have to use a lot of energy. And basically, there are some other factors which may get lost for the Bitcoin. So you need more altcoins. So essentially, the chain is growing, so it becomes very difficult to mine. And there are other use cases of coins, cryptocurrencies. That's the reason you see Bitcoin getting its chain lost, whereas other altcoins are picking up. So reason is, I'm just trying to define here. Reason is, while some are just identifying to modify the Bitcoin, others are trying to have an innovation. So what is it has more functions like smart contract. For example, Ethereum. Improve fungibility and privacy characteristics of currency itself. So also increasing or altering the hash mechanisms. And also there are some mechanisms where you can use less energy intensive processes. So that's the reason why people are spanning towards altcoins, and there are some of them are like Ripple and Made Safe, or some of them. So, but main reason is these 5-6 reasons. So that's the reason you are seeing alternative currencies. So these are some of the currencies. You have close to 2,000 odd currencies as of 2018 closing, and there is a market cap. This is a little old slide, but the market cap is very high nowadays. And there are a lot of assets that's been traded also using these exchanges. The next best is Ethereum, that is in the left hand side first one. So you can see this: Bitcoin, Ripple, Litecoin, Stellar, Monero, Icon, Nano, Tron, Binance. These are some of the coins, and you can see Ripple, Monero, Ethereum Classic, Litecoin, NEM, Augur. These are some of the indicative coins that's actually happening, and the prices have changed to a drastic level in 2018. So basically, not all coins are equal, right? So basically, every coin has its utility, and it's not on the same dollar value, and it's not on the same market cap. So it keeps changing, and there are a lot of coins which is favored by the developer community, and there are some coins which are favored by the financial community. So it depends on where the use case is. So, but then you have seen proof of work algorithms is kind of developed. I've also mentioned some of the next generation mining equipments like Script, which is used for Litecoin and Dogecoin, and Crypt N is like for X11, X13, which is very popular, and this is kind of used in dark coin, cloak coin, Bitcoin, etc., etc. So there are a lot of development that has happened in the mining world. So that's one advantage of alt currencies. More development, there are something like proof of stake. It doesn't have to be like just having proof of work. Just holding them is like proof of stake. There's some anonymity increase. Then there are other things like Ethereum basically gives a framework and programming language even for creating cryptocurrencies. Basically, the product development, if you see on the right hand side, is such advanced nowadays. So from a typical mining proof of work algorithms, now we have got other type of development that's happening in the cryptocurrencies. So let's end this here. After that, we will learn about altcoins and how to mine altcoins. Welcome to this session. As we have discussed before, we will cover altcoins and mining of altcoins in this session. How to mine coins? You have CPU mining. We have GPU mining. It's very efficient. You have ASIC mining, which is fastest but bit expensive. Then you have entry-level ASICs. You can try eBay. There are a lot of equipment that's listed. You can even purchase that, and you can see and maybe you don't become more bankrupt. So these are some of the advantages of using mining. Then there are a lot of cryptocurrency exchanges, be it Bittrex, Binance, and Cryptsy, Minpearl, and more. So where you can see price volume order done, where you can do price like it's like a stock market or a stock exchange. So where you can purchase on 24-hour basis for any of the currencies. Basically, how to use coins? It's like it is fun. You can donate to good causes, and there are new horizons that's coming up. Basically for gaming apps, or there are something like music paid by cryptocurrencies. So you are seeing new frontiers. But what are the common characteristics? They all have common characteristics. First is they rely on cryptographic hash functions and asymmetric cryptography. First. Second, most are designed to gradually introduce new coins into circulation. Third, all have a specific rate of issuance which may be capped. That means like you have a maximum number of coins. For example, in Bitcoin it was 21 million. Similarly, Ethereum and Litecoin and Ripple all have a pre-programmed supply. And the response to demand and supply is what we need to follow. And there are some key performance indicators that we need to map, keeping in mind when you are assessing cryptocurrencies. The first one, they have a cryptographic hash functions. They are designed to introduce new coins into circulation, and they have a maximum ceiling or capping on the digital currency. So the core difference between the decentralized digital currencies, proof of work, stake, resources, whether coin can be mineable or non-mineable, and what are the alternate uses of mining energy, and what are the total supply. So you can see these are the broad level categorization of digital currency. First, whether like Bitcoin, it is proof of work. Proof of stake, there are some coins. Whether it is mineable or non-mineable, that's the second characterization. Third is they're using other mining energy issues, and what is the total supply. So first one is a basic element of consensus and incentive method. That means proof of work. But basic element seems to be consensus and the incentive method. So what is proof of work? There are different methods, concepts behind the process through which one can provide the proof that there is a trade-off. That means like you empower the network to ascertain the participants to act rationally and mine new coins. That means like there is a yearning or incentive that is given to the miners. So if you see proof of work, you have proof of burn, proof of work, proof of stake, proof of importance, proof of concept, and proof of authority. But what is proof of work? Mining is required to gain coins. So which is mostly based on script, hash script. Proof of stake is coins you are earning as a reward. Proof of resources is recognition of contribution to network. Proof of burn means bootstrapping one cryptocurrency for another. So you have proof of work, you have proof of stake, you have proof of resources, and proof of burn. Proof of work means mining. Proof of stake means coins in order as a reward. Proof of resource means recognition of contribution. Proof of burn means it's basically bootstrapping one cryptocurrency after another. So proof of work is actually, it's like a challenge versus solution verification. Here the client requires a challenge. That means like one party present the result of a computation to compute. and easy to verify. But whether the performance of the prover or the client needs to be proven using the certain computational work to get the results. So you have kind of challenge response versus solution verification. There are some of the classics of proof of work protocols. There are 7-step process in terms of challenge response, and it's a kind of 4th response in the solution verification. Whatever the proof of work may be. Basically, these are challenges process to give a best solution to make sure that the mining happens with the minimum amount of computational power to generate that new coin. So you have something like very hash algorithm. So SHA 256 for Bitcoin. You have Litecoin, which uses script algorithm. And you have hybrid and CPU algorithms in Primecoin. You have X11 algorithm Dash and Cryptonite basically for Monero. So proof of work system is very important, and you have KEKAT, which is the 512.256 from used by Ethereum. So these are some of the hash algorithms we have seen, right? And proof of work is actually determined by the algorithm that used for verification mining. So that's right, and that is secure. So these are the algorithms which kind of different altcoins and Bitcoin uses. So you have SHA 256, Namecoin, Peercoin. We have seen much details in the earlier one. What is SHA 256? So basically, SHA is designed such that for every unique input there is a unique output. Examples of coins using script algorithm. So what is script algorithm? It uses a password-based key derivation function. It generates the demands for the algorithm, and there is a memory-intensive procedure which is parallelized, like using application-specific integrated circuit technology. So it's kind of what is called a script algorithm. So it is a password-based derivation function. Second, it actually gives demand. It's based by the demands of the algorithm. Then there is a time memory trade-off to see when mining can happen, and it's memory intensive, and basically it happens like a parallel processing with the application specific integrated circuit technology. So examples are Litecoin, Feathercoin, and some stuff like that. So then there is something called X11 algorithm, which is Dash. So again, X11 is a chain hashing algorithm that uses 11 different hashing functions to calculate the block header. So you have seen, right? It's a header nonce transaction. That's how it happens in Bitcoin. Similarly, here a Dash algorithm is like, or what you call X11 is, it's like a proof of work algorithm that uses 11 different hashing functions. And this is also intended to be ASIC resistant and to see that CPU and GPU friendly. So this example is Dash network for X11. Proof of stake is the second one which we are trying to learn. Here, instead of performing the task of solving the mathematical difficult problems, the proof of stake means that a owner of coin can earn coins, but proving that she owns certain amount of coins. Very, very simple. So deterministically, proof of stake is just showing that instead of mining of coins here, this just showing that there is a certain amount of coins with the owner. So this is where you see some of the snippets which it started in 2011 instead of proof of work. So proof of stake is actually an algorithm used for verification, and the first 100% POS currency is called NXT coins, and they are charging transaction fees. Just for example. Then there are some hybrid algorithms where you have proof of work and proof of stake. Peercoin is just an example. Again, you see there is an innovation that we discussed in the beginning of the altcoins, cryptocurrencies. So basically there is a shift that's happening from the proof of work that Bitcoin started. Then there are other coins, secure coin, Quark coin. These also use hybrid algorithms. Then proof of resources. Let's understand what is proof of resources. The scheme is based on the notion that end users can earn coins by contributing to the network. That means more resources they use, they can mine coins for themselves. So these users are called farmers, and they receive the reward for maintaining and supporting the network. Very, very important. So basically, to grow the network, to increase the popularity, to increase the hash rate, to decrease the compute power, and to have faster production of mining and coins, these people are called farmers, and they receive the award for maintaining and supporting the network. So how it happens? Farmer uses constantly measures and verifies the resources, and resource provided must exceed usage, and then they take care of the entire network. Then This is another one, proof of resource, where something like safe coin is used. Safe stands for secure access for everyone. Let's understand what is proof of burn. The idea is that miners should show proof that they burned some coins. Like initially they would have produced a coin, namely they would have used Ethereum to generate cryptocurrencies, but they've understood that over time there may not be utilization of these cryptocurrencies. So what happens is they will burn all the currencies or the coins because they are not being consumed. So there's a significant discussion on the Bitcoin forum, and to date, like all proof of burn work by burning. So basically they make sure that it is properly utilized. It should not happen that these coins are lying and then they're actually used for they're not being used. So basically it shows that the miner should show proof that they burned some coins. Proof of burn is actually important because there's a market cap and they're not using the coins as per the demand. It's better to burn the coins. The counterparty is one coin which is using proof of burn. So, and now let's explore how coins are introduced in the system and how rewards are processed for work. So there is a pre-mined or merged mining. Some currencies are pre-mined, which means that coins are mined from the creator of the cryptocurrency before it's actually released to the public. They can sell them in public. They increase the coins, leading to the cryptocurrency to deflation. So there are pre-mined, like there is like already they have 10 million coins, 20 million coins. They are pre-mined before they release to the public. But what happens is actually once they start supplying and the supply of coins go increasing, then it becomes deflated. It loses its value unless there is a consumption of this mined coins. So basically, there is a interview in the Guardian which says it's like you might not know the actual required number of coins. So it's like pre-mined is little risky, and it's actually increasing more and more disk space, and it's not necessary. But understand that moreover the pair of group of currencies that need to be choosing for merged mining or pre-mined to be on the difficulties level. That means like you have to produce hashes that are proper for one network each time and providing with less opportunities for synergies. So the more running more than one client is very coarse resource consuming, because you need to be understanding that everybody should have an optimum release of coins. So Ripple is a project that ran before Bitcoin, but actually it's a similar system, but this is called as basically this is usually used for transferring the foreign exchange currencies, and they were there is no mining process, and 100 billion XRP were created and 80 billion were given to Ripple Labs, and basically they use a payment gateway or a transaction gateway for issuing the transaction. So transfer is very fast, it takes 2 to 5 seconds. But then they have now XRP is actually used in some of the banks, and these pilot projects are going on. What I call XRP is Ripple. So the third is, can the mining effort be productive for other things as well? Let's understand. So alternate use of mining energy. Mining as a process requires a significant expenditure on significant energy. While there is a use of success of POW, that is proof of work, there's better to have an alternative. So there is now again finding smart algorithms that is efficiently using energy, and then for example there's a Cunningham chain which is used by Prime Coin. So this Prime Coin offers academic utility and attention to modern men, that they just go beyond the mining cryptocurrency. So there is energy efficient algorithm that's coming for even using mining equipments. And then the last criteria is there any significance of the total supply and the new coin introduction? Yes, we have seen that it may lead to deflation, but let's understand that. So the total supply of Bitcoins and reason was 21 millions, but this was led to I don't know what is the reason, but then basically it is important to have a cap, the rate of issuance until the total supply, whether the issuance is based on what model of consensus, that's hybrid by POS or POW or whatever, whether will it be increasing, whether it will create inflation or trail emission. So basically you need to have a balance of these to see what is the total supply of coins that you need to mine. So we have seen alt currencies and we have understood why it is important, what are the critical characteristics of alt currencies, and why supply is important. That's all for this session. Next we'll cover about ICOs. Thank you. Welcome to this session. Let's talk about ICOs, or I should say initial coin offerings. So we have seen a bit of what is cryptocurrency, what are alt currencies. Let's discuss on what is called as initial coin offerings. This has been on the famous thing in last couple of years, at least in last 15 to 18 months or so. So what is an ICO? Basically, it is a way to finance a company or a project via crowd sale of tokens or probably coins. So it's like earlier than even seed stage. I will give you some brief in the next couple of slides. Basically, you can have donations as expected, that's one form. Or investors receive tokens in proportion to their investment, or tokens, again, they are used on trading on exchanges and they are used for projects as well. So what is ICO? It's called initial coin offering. Why all the because you have seen at least like 3 billion. It's actually surpassed the venture capital investments in 2017. So there are a lot of entrepreneurs who love ICOs because they have much better value and its terms than traditional venture capital, and it's also a great way to expand your product or user base while raising capital. And some of the times, like, it has yielded spectacular ICO results, in the trading. For example, Ethereum had resulted almost like 1000x times, and at least there is a minimum of 2 to 10 times returns in months, so that's like once it start trading and you have a good use case, there's a good returns as well. So basically, what is the mechanics? First, you do a marketing website, you create a white paper. It's a strategy paper on technology, how you are positioning your product or a platform, or for what cause it is used. Then you actually generate your own coin, or you make your own coin and basically collect funds through Bitcoin or Ethereum, and you deliver tokens to the investors and trade on exchange. So, and that's how you can create your ICO. So basically, this is a new way of becoming a millionaire, and for your products, So economics have to be very important, and there are a lot of people who have bought BTC, that is Bitcoin and Ethereum, at a low price, and they are now crypto billionaires. So you can see like Bitcoin, which did like equivalent to, there are coins that never did ICO. For example, Bitcoin generated 125 billion, Litecoin is 3 billion, Monero is 1 billion. But the new currencies that's coming in the market is actually creating basically for generating revenue, producing a product through the crowdfunding. So what is good about ICO? A new form of credit creation. So basically, coins or the tokens go straight to the communities. Then they have the wisdom of crowd. Basically, it's a good indicator for demand. It's actually unregulated for now. A lot of innovation is coming. Government is thinking about this to regularize this, and it's immediate liquidity. Like you buy 25 coins of say a good ICO, and you can exit once listed. It can also be thinly traded. That means like you can always, like a stock market where you can trade even 1 coin or 2 coins or tokens. Bad is like sometimes too much money is raised because we don't know whether or right optimum money. There are some unqualified teams, like there is some bogus things happening here. There are some scams because there are stupid projects, but actually coins should not have existed. And sometimes they are just doing this for immediate liquidity. So that's actually becoming a deflation. So on the contrary, you have some advantages about ICO, but you also have equally number of disadvantages. So Ethereum raised 17.3 for distributing 50 million Ethereum at 0.35. Currently in end of 2018, it's like trading between $150 to $175 per Ethereum. Tezos raised 232 million. These are some of the good examples. So how does it differ from an IPO? An IPO actually involves the issuing of shares or some definable token security as a trust or a company. But equally, ICO involves the raising of capital without giving any equity stakes, but designed to drive interest and usage of the product or service or the project. So the investor subscribes a kind of a cryptographic digital tokens which is operated only in a prescribed blockchain, for example, platform. For example, Store's ICO issued 30 million worth of tokens which is used by store services, but that is being offered by stores. So it's little different from IPO, and this is a new generation IPO, as I can say. So consequently, instead of securities being offered, the ICO offers a token which can be later used as a payment for some service or commodity. But the thing is, like, token can fluctuate in the market but never be used as a service payment. So there is little difference in terms of how ICO offers and how it is differentiated from IPO. So let's see how public blockchain is aiding ICO or initial coin offering. Some of the most successful projects are financed through Ethereum platform, because they are the ones, Ethereum are the ones which you can create your own cryptocurrency using Ethereum forking, and it is not very expensive, and it's like open, permissionless, and it has a guarantees a consensus between dependent and independent participants. Third, most of the white papers are just created, or most of the initial coin offerings are basically as an ideation stage, and better to see which are the projects going into the production stage so that it can be useful to see where to invest. So basically they are using most as a utility token. That means like utility to pay electricity bills or mobile bills and things like that. But actually, if you see like a good use case, then ICO is a good way of generating cash for developing the product. And the best way is to see if you have a good implementation project which is almost like in a ready stage, or which is almost in production. So these are most white papers just lack justification of blockchain use. Basically, they just try to attract introducing new blockchain in the papers using white papers, but they don't have a reasonable justification for blockchain use. So the most commonly used phrases you can see, we are creating a community, creating Web 3.0, making the world better using blockchain. These are some of the cliches that they are using. So we have to be very careful in choosing the blockchain ICO that is required, and which are the right projects, be it at a mature stage, that we can invest and get some good returns. So these are some of the dollar millions that has gone up in the instance ICO, and for what all the reasons. You see some of the places like finance is increasing. It is also used for health, gaming. So there's quite a few ICO projects. Again, you can see infrastructure projects. Finance leads it, at least 22 projects. They've raised about 577. Bit old data, but then it still exists. And the average investment is like 28 million. And you can see on what are the various use cases of public blockchain, and which is much more useful rather than just utility token. So let's understand what is ICO platform and how it is ruled with the smart contract. So ICO projects either use existing or custom blockchain platform. As I said, they can use Ethereum, Bitcoin, Litecoin, any of these platforms, or they can create a new network, and they can attract miners and pay for transaction confirmation. And most projects use, actually Ethereum is the most overloaded as of now. And the thing is, what is smart contract to do here? Basically, the terms and conditions of the token are defined in the smart contracts, and it should be very, very important that you should be able to understand the smart contract, and which should not result in loss for both investors and founders, because if there is a wrong code that is written in the smart contract, that will be very difficult. It will not give a fortune, but it will be making a bankruptcy for both investors as well as founders. So you can see Ethereum is the leading platform for smart contracts. So you will see at least 77% of the projects are on Ethereum. So till November 2017, you can see the transaction that happened on Ethereum, it's completely overloaded. And an average cost you can see is something like 523.3 in December 2017 for deploying a smart contract. So ICO and smart contract. So basically we need to make sure that smart contract can contain hidden terms that are not explicitly disclosed to investors, or it may contain unsafe algorithms basically on the smart contract logic. So basically it is unintentional violation of smart contract logic with functions used, and as well as the non-standard functions. So we have to be pretty careful about this whole end game. So let's understand a bit of token valuation. So current token valuation is more like a gold valuation or a fashion item in high season, when a limited supply cannot meet high demand. With balanced demand and supply, the valuation would be determined by the project forecast and token in nature. But in most cases, it's just a hype. So you have to be very careful that the token economics of a token should be categorized for which ICO. So basically, you see, like currently it's a utility token that I've been using it. So in terms of ICO, you should be understanding whether it's the right type of token, or whether it's a security token or an asset token, or it's a utility token. So there is the traditional token valuation as a means of payment is based on parameters that are difficult to determine the development stage. So it is like what you call it as TV equal to PQ. That means P is the price, Q is the volume. So but then the token economics varies between each ICOs. It also depends on what is the utility value inversely proportional to the cost. So understand that it's depending on the value of demand and supply. Then depending on the type of tokens, whether security or asset or utility, or it's like based on the price and volume of the token. Then it's also, you can see like there is capped funding and there is uncapped funding. That means like you can fix price based on what are the minimum number of million tokens that supplied. And second, uncapped, basically they will see the demand and then they will create a capping based on the rush. So you need to understand various token valuation methodologies, but it's completely different from the venture capital valuation. So the token valuation is based on fear of missing out. That should be like, while it should be based on project development and nature of token. So as I said, the most common type of IC is a payment of services, but it's not based on the valuation on the development, project development. So that has to be the important thing. So we have to be very careful to come out of this fear of missing out. So they fear that they will miss out the chances, so they are looking at transfers of funds from investors at record speeds. So there are a lot of places where you have seen like they are transferring funds at a very fast speed. Even another reason for Ethereum and Bitcoin price to grow is basically based on the ICOs. Like more and more companies use Ethereum and Bitcoin to transfer cryptocurrencies, or in the form of Ethereum and Bitcoin, the price of the Bitcoin and the Ethereum also will rise. And that's where you can see the rise of Ethereum up to $500 per Ether. And you can see some of the price changes that's happening in this chart, and some of the companies that have generated cash through extreme volatility. So with that, we are completing what is an ICO and what are the reasons why we should invest in ICO. We should not bother about FOMO. Moreover, we should depend on the development of the project. It's better not to invest in a utility token, rather than we can look at an asset or a security token. And the token valuation is key. There are a lot of mechanism of token evaluation, but it's better to evaluate a token or a coin depending on the utility, depending on the use case or what is the problem it solves in the globe. So this is the end of the third module. With this session, we'll conclude this module. Hope you have enjoyed module of the blockchain course. Now you will see in the next module, which consists of some blockchain frameworks, mainly Ethereum, Hyperledger and Bitcoin. Thank you.